Kangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello, welcome to the COB. I'm Juliette Sarli. Great to have your company this Thursday as we sort of flatline into the close. Let's have a look at where the CBO 200 is finishing the day's session. We did have that dip around midday to 2 p.m.-ish. Really being dragged, I guess, mostly by what you saw from BHP, but we've managed to rally into the close. So to close pretty unchanged from yesterday's good gain, and the S&P ASX 200 heading into match off is down just 3.5 points today. It is the material sector, though, giving back, and that is really as we start to see a bit of a minor lag. The miners very much the laggards today, but do remember that yesterday BHP had that really solid gain. Today there was a little bit of, I guess, consternation about its quarterly outlook for copper. That saw some investors pull back, possibly some profit taking too after it had that 4% jump. So that is weighing on the material sector, which is down by 1.6%, and the energy sector also down by 1.4%. Data deluge, this is really interesting. We are going to see Australia's AI infrastructure race accelerate, with one of Australia's largest data centre precincts to be built in Sydney's Macquarie Park. Macquarie Technology securing more than 8 hectares of land for $240 million to build a new $3 billion data centre. Now, Macquarie data centre boss David Hurst has really defended the surge here in data centre development, arguing they're critical to national infrastructure and to help keep government and business data on shore. And TSMC triumphs over in Taiwan. We saw Taiwan Semiconductor posting quarterly profit that beat estimates, just highlighting this robust global demand for AI computing. Let's have a look at some of the sectoral moves in today's session as well, kicking it off with those miners which came under pressure, sending BHP back below $60 a share and Rio Tinto just under 164. The energy stocks I mentioned also coming off somewhat as we saw crude oil prices pretty much hold firm overnight. This new wave of US attacks against Iranian military installations aiming to limit Tehran's ability to strike shipping in the Strait of Hormuz, and that offset a smaller than expected drop in US crude oil inventories. And then a quick look as well at some of the telcos today. TPG Telecom having a pretty solid session. Well, BHP reported record full year 26 iron ore and copper production and did maintain its full year 27 production guidance. But as I mentioned, it flagged lower copper output from Chile next year and also a $2.3 billion impairment on its Jansen potash project. AMP was one of the best performers on the market today, expecting first half underlying net profit between $170 to $180 million, supported by stronger contributions from its China partnerships. And there's Macquarie Tech after it secured land for that $3 billion data centre in northwest Sydney. Netwealth Group also in focus, a little bit weaker, did report record funds under administration. It expects full year 27 net inflows between 18 to $20 billion. Perpetual received a revised $22.07 a share non-binding takeover proposal from EQT, and Technology One announcing a leadership reshuffle. We're also going to be speaking to Technology One CEO Ed Chung tomorrow at 11:50 Sydney time, because they're weighing in as well on Prime Minister Anthony Albanese's AI build-out. But let's talk more stocks now, and welcome to the COB. Mathan Somasundaram from Deep Data Analytics. Always good to see you. You're back in space or wherever you sit there, Mathan. I just wanted to get your thoughts on how the big Australian seems to have been shaping market sentiment the last couple of sessions.
Yeah, the two biggest stocks are BHP and CBA, and the global flow tends to, manage the market through those stocks. Yesterday, the market pulled back and BHP had a big run, and that held the market to flat. And today was the reverse. BHP got into trouble and CBA was the savior, and CBA pushed up the market and we kind of gave back most of the gains we got yesterday in BHP. Interesting update. I mean, this is not the first downgrade. BHP's downgrade multiple times now. And the Chinese data hasn't been as strong, despite the market for the last couple of years have been hoping for Chinese stimulus. The property market and the infrastructure build out sentiment remains relatively weak in China. And despite that, iron ore held up above 100 for a long time, and it's now below 100. And that's potentially is going to be a bigger problem for them, because if China is not building out, then the demand for steel, iron ore, coking coal, all will be in a weaker cycle.
So, do you think that the selling in BHP was about the outlook, or just because it did so well yesterday, people were like, oh, I might take a bit of money there?
I think it's just a bit of both. I mean, there's a fair bit priced into the multiple now for BHP. You're getting a few negative headwinds. You've got production issues. You've got copper doing that well in the context that the price is so high, starting to hit demand, because most of the, I guess, the customers buying are emerging markets and they've got currency problems. So, historical high copper prices in US dollar when your currency is going down kind of limits how much you can buy. So that's one of the negative side of things. The Chinese data is not quite there. So for the where the share price is and the expectations of the commodities, you need a strong China and you still need a decent global growth. And I think what we're seeing out there is weaker global growth, and China is a bit unstable at this point. And I think even China can't withstand a slowing global growth. So in that context, I think BHP is probably relatively well priced. So it makes sense to take some profit here. I think the upside is relatively limited in the short to medium term. We need to see some, I suppose, country level stimulus to kick in to major economies for a construction cycle to turn that cycle. So I think in the short term, I'd be taking profit.
And what are you seeing in terms of the overall, growth to value rotation as well?
Yeah, look, we've had that in the local market for a couple of years now. And I mean, every retail investor out there probably held a number of growth stocks, and most of them have been absolutely bashed up. And so we've actually had a massive rotation out of growth into value. But if you look at it on a global basis, especially in the US, which is dominated by growth stocks, that has only barely started. So we are seeing that, and a high bond yield and a rising bond yield tends to make that happen. And I think that's where the overall cycle is. And while that plays out, it's really hard to see growth outperforming. So the investors, whether they do it by design or by stealth, they're chasing value stocks, they're chasing yield stocks. And that would be the thematic that's potentially going to be outperforming in the second half of 2026.
But you also point out that maybe tax changes will be, another reason behind this yield thematic.
Yeah, yield has been outperforming for a while, and I think the local tax changes will make yield investing a lot more palatable. So in that scenario, you're also getting relatively cheaper multiples. So you're getting this mix of value and yield, where for a number of years everyone chased pure growth plays where they paid no yield. So this dynamic of switching has actually made boring stocks sexy again. You've got your APAs, your rural funds, your New Hopes, your Woodsides, your Telstras. Anyone who's paying 4 to 5% yield or better is going to get a lot more attraction.
What are we seeing as well with the overall looking at, I guess, consumer, not necessarily discretionary, but staple stocks, so food stocks, particularly as we know this is a land of droughts and flooded plains?
Yeah, the time to buy is when everyone thinks you've got massive drought coming, and that's how the agri sector has been priced in, whether you're looking at Elders, whether you're looking at Select Harvest, GrainCorp. They're all pretty much been beaten up, and the expectations is that you're going into a drought. A lot of them actually pay pretty decent yield in a recovery cycle, and if you look at food prices, they're still quite well elevated. There's a lot of supply side disruption around the world, so demand for food is going to remain elevated. We all know when we go to restaurants, when we go to the supermarket, you realize how much you're paying. So food prices are not going to be coming down. If you think there's going to be supply side disruption because of transport logistics or weather, that means even higher prices. So I think the food sector is really underestimated. And generally, when you want to look at agri-food sector, you want to look at it when the market doesn't want to touch it. And that's pretty much now. Everyone is looking away because they're worried about the weather. All you need is the weather to be a bit better than what most expect, and things turn positive. And the reality is, forecasting weather is the only thing that's worse than forecasting markets. So chances are we're going to be wrong on the weather and it'll be a bit better.
Yeah, I always love when there's like 5, weather updates in the news and you're like, okay, how are we going to know? Just look out the window. With energy though, the overall supply disruption here, what do you see in terms of where that moves next?
Yeah, I mean, the Middle East has been, it's very uncertain. I don't think it's going to be resolved anytime soon. I think the damage to the supply side infrastructure and transport logistics is quite dramatic, and I think that'll have an effect for a long time. That being said, the only reason oil prices in the previous cycle in the last couple of months didn't run up to 150 is because every major economy was dropping their strategic reserve into the market. So, you look at US, I think it's back to the early 80s. So there's a fair amount of strategic reserve that's being destroyed. Now, if you have this, the current, I suppose the restarting of the war, if that extends, and reality is US has been dumping strategic reserve on the market for a number of months. They never stopped. Even with the MOU, they were still dumping on the market. So in that scenario, that's not a sustainable strategy. And US literally told you so. I mean, that's why they did the MOU, because they couldn't keep supporting the market. So if you think about the amount of damage that's done to the infrastructure, then you add to the fact that a lot of major economies have already burned their strategic reserve. I don't think this is sustainable. And at some point, even if things have resolved themselves, they will have to rebuild their strategic reserve. So demand will pick up just on that aspect. So I'm pretty positive on energy. If you look at historical cycles, when you have inflation cycles, which is what we're in, gold runs first, and then energy follows, and then food follows after that. So I don't think it's different this time. Inflation has come off a bit in the last month, mainly because of oil price related. Now that oil price has bounced back again, you're probably going to see inflation going up again. And I expect everything to return to the usual inflationary cycle. So I think over the medium to long term, gold will keep doing well, energy probably will do well, and food will follow.
All right, food will fall. Nathan, thank you as always. Actually, I'm going to keep you there for 1 second just because when you talk about that, I read a really interesting note today, I think it was from EY, about how they think something like 10% of Aussies will be on GLP-1s at some point, in the next sort of 10, 15, maybe 20 years. And the impact that that is having on what we buy as well. So less food, but more clothes. People feeling better about themselves going clothes shopping.
Look, you have, it's hard to argue with that logic. I mean, it's something that when it first came out, we weren't sure how much of the population will be taking it. You can see pretty clearly there's a big uptake of that, and that will have a change in effect. And you've seen a lot of takeaway food retailers take a hit on the back of that, and I suspect that is going to be an issue. But the question would be, it is also partly affected some of the healthcare stocks. You've seen pullbacks in ResMed and stuff like that on the back of that. So there is an effect on that structurally, but the question would be, does it have any side effects? Does that work for everyone? And that's what we don't know. But I think it's logical to assume there will be some demand destruction, and that's going to happen in multiple sectors. So it's happening, and I think the market is reacting to that already.
Yeah, that's a great way of putting it, demand destruction. Mathan, thank you as always. Mathan Somasundaram from Deep Data Analytics. Well, getting to the stock of the day, it was a US special on the call today, and the stock of the day was Netflix, as we wait for Netflix to Netflix and spill with its results today. Andrew spoke to our experts Kai Chen from MPC Markets, Mark Morland from Value 3.
Shareholder, not a big position, but I've been a shareholder for quite a while. It's done very well for me. I think going forward now, I think the challenge is, and just from what I've read lately about it, is that that viewer engagement has been dropping off as far as how many hours per week and there's plenty of competition. And so I think the market sort of got to a point where it sort of is changing to somewhat. And I think whether Netflix can really bump revenue, they haven't had any blockbuster type series like they used to.
They're trying to go down in terms of gaming. I don't know if it's the right thing to do, because to me that doesn't seem the right route. One, like how do people engage with Netflix on a gaming platform, right? It's not the domain they're usually in. So it's a tangent, but I don't know how well that will play off. It's a risk as well. One positive is that the advertising revenue is going up, but again, to sustain that platform, they need to have good content to keep the users there.
Let's have a look at the market leaders on a flat day for the overall market. AMP there though, with its profit upgrade, sending its shares higher. Mesoblast had a broker upgrade. You can see Rudy Philip van Dijk's views on that on ausbiz.com.au. Lovisa also looking good despite everyone being all doomsday about how much we're spending on consumer discretionary. It was up 4.5%. Let's have a look at the laggards, including electro-optic systems, a bit of a switch out of defence, a lot of switch out of lithium too as well. You can see Elevra down 5%, Liontown off by around 3%. When it comes to the small end of town, Fleetwood had a very good session, up by some 24%, as did Amplitude Energy, up 7%, while the laggards in the small end of town included Addison, down 9%, and Felix Gold, which was off by around 8%. Well, I gave it away a little bit before that Netflix is out with its numbers today, but let's have a look at what else is coming through. We've got those weekly initial US jobless claims, retail sales as well. Bank of Canada out with an interest rate decision. And it's not just Netflix, we're also getting GE Aerospace, United Health, Abbott Labs, American Airlines, so very much ramping up here on second quarter earnings. Let's have a look at what we expect tomorrow locally. US President Trump will be delivering an address early on, and a quarterly update as well from Northern Star. I mentioned as well that we're going to have some moves coming through from Technology One in terms of that we'll speak to the CEO, Ed Chung, at 11:50 AEST, so please do join that conversation. But let's have a look at where we are seeing the momentum or not on the market. Very flat there as we finish out the day's trade. I'll just get you a quick check on where the S&P ASX 200 is also tracking. If my computer decides to wake up, it is down, not even 1 point, 0.4 of 1 point to 8,840. I think we would call that flat as a tack, as my grandma used to say. All right, that does it for today. We'll be back from 9:45 a.m. Eastern tomorrow.